You may have recently acquired some cash. Congratulations if so. Or maybe you're preparing to begin aggressively saving to accumulate a portfolio of $100,000 dividend stock. Regardless of your circumstances, let's start today's investment adventure. Additionally, find out how much $100,000 in dividends will earn you. Depending on your portfolio's dividend yield, you can receive a specific number of dividends with $100,000. Stay tuned until the end of the video in order to know all about the dividend yield and how much potential it has, leading to how much dividend income can you make from $100,000. And it's not what you think. So, if the dividend income from a $100,000 investment in dividend stock is determined by portfolio dividend yield, what then is the whole concept? Dividend income can vary greatly depending on a number of factors, including the type of investment, the stability and performance of the investment, and the current interest rate environment. Let's first go over what is the potential dividend yield and how we calculate it. Potential dividend yield and how it's calculated. The portfolio dividend yield is a measure of the total dividends received by an investor from a portfolio of stocks or other investments as a percentage of the total value of the portfolio. It is calculated by dividing the total dividends received by the value of the portfolio and expressing the results as a percentage. For example, if an investor such as yourself has a portfolio valued at $100,000 and receives $5,000 in dividends over a certain period of time, the portfolio dividend yield would be $5,000 divided by $100,000, which equals 0.05 or 5%. The portfolio dividend yield can be a useful measure for investors who are looking for income from their investments. A higher dividend yield typically indicates that an investor is receiving a large percentage of the portfolio value in the form of dividends, which can be attractive for investors who are looking for a source of regular income for their investments. The portfolio dividend yield is just one way to measure the performance of an investment portfolio. Other measurements of performance include total return, which takes into account both dividends and capital appreciation, and the internal rate of return, or the IRR, which measures the rate of return on investments over time. In addition to the total dividends received, the portfolio dividend yield can be calculated by using the dividends expected to be received over a certain period of time. This is known as the forward dividend yield, and it can be used for investors who are trying to forecast the future income potential of their investments. The portfolio dividend yield can vary widely depending on the type of investments held in the portfolio. For example, a portfolio made up of dividend-paying stocks or high-yield bond funds may have a higher dividend yield than a portfolio made up of growth stocks or low-yield bond funds. It's important for you to consider your own investment goals and risk tolerance when choosing investments for your portfolio, and to carefully consider the potential returns and risks associated with each investment. It's also worth noting that the dividend yield of a particular stock or fund may not remain consistent over time. Dividend payments can be increased, decreased, or suspended altogether, depending on the financial performance and dividend policies of the underlying companies. As a result, it is important for investors to regularly review their portfolio and make sure that it still aligns with their investment goals. Now let's consider a few options. Number 1, $100,000 dividend portfolio of Dividend Aristocrats. Dividend Aristocrats are a group of companies that have a track record of consistently increasing their dividends over a long period of time. These companies are often seen as attractive investments for income-oriented investors, as they may provide a reliable source of income in the form of dividends. There are several potential benefits to investing in Dividend Aristocrats. Dividend growth. As mentioned, Dividend Aristocrats have a history of consistently increasing their dividends. This can provide investors with a growing stream of income over time. Financial stability. Companies that are able to consistently increase their dividends are often financially stable and have strong business models. This can provide investors with a sense of security and may make those stocks less volatile than other types of investments. Potential for total return. In addition to the income provided by the dividends, Dividend Aristocrats may also offer the potential for capital appreciation. This can provide investors with the opportunity to earn a total return that consists of both income and capital gains. Yield. Choosing 10 or so stocks among the more than 60 aristocrats that are now in existence, you can expect a 2% or so portfolio dividend yield as a result, possibly somewhat more or less. It mainly depends upon the precise stocks you choose. With a 2% return, a $100,000 dividend portfolio will provide $2,000 in dividends annually. Number 2. $100,000 portfolio investing in closed-end fund. Closed-end funds, or CEFs, are investment companies that issue a fixed number of shares which are traded on a stock exchange like any other security. CEFs differ from open-end funds in that they do not continually issue new shares or redeem existing ones as open-end funds do. This means that the market price of a CEF share may differ from its net asset value, or the NAV. The following are several conceivable advantages to investing in closed-end funds. Potential for higher income. CEFs may offer higher dividends than open-end funds as they may use leverage or borrowing to boost their income-generating potential. Professional management. CEFs are managed by professional fund managers who are responsible for making investment decisions on behalf of the fund. This can be beneficial for investors who do not have the time or expertise to manage their own investments. Diversification. CEFs often invest in a diverse portfolio of securities, which can help to spread risk and potentially reduce volatility. Potential for capital appreciation. In addition to the income provided by dividends, CEFs may also offer the potential for capital appreciation. The dividend yield on this fund is a staggering 10%. Therefore, a $100,000 investment in the IHD will provide a $10,000 in dividends every year. However, because they use leverage, CEFs may be more volatile than open-end funds, and their market price may differ significantly from their NAV. In addition, CEFs may be more expensive to own than open-end funds, as they typically charge higher fees. Hence, they can be a little bit riskier than others. Number 3. Using a hybrid strategy for dividends on $100,000 investment portfolio. A hybrid investment strategy that focuses on dividends could be a good option for people who are looking to generate steady income from their investments. By combining dividend-paying stocks and high-yield bonds, for example, an investor may be able to achieve a balance of income and potential capital appreciation. There are several potential benefits to using a hybrid dividend-focused investment strategy. Diversification. By investing in a mix of asset classes, a hybrid dividend-focused strategy may help to spread risk and potentially reduce volatility in the portfolio. Potential for elevated earnings. A hybrid dividend-focused strategy may offer the potential for a higher level of income compared to a portfolio that consists solely of dividend-paying stocks or bonds. Potential for financial appreciation. In addition to the income provided by dividends, a hybrid dividend-focused strategy may also offer the potential for capital appreciation. Invest in a couple of dividend aristocrats with lower yields. Choose a few equities with dividend yields ranging from 4 to 6%. Additionally, contribute a little sum to a high-yield closed-end fund of your choice. This would ultimately help you in generating a steady income on your investments. Tips on efficient investing for higher dividend yields. Number 1. Consider the dividend history of a company. Companies with a long history of consistently increasing their dividends may be more likely to continue doing so in the future. Number 2. Look for companies with a strong financial position. Companies with a strong balance sheet and stable earnings are more likely to be able to sustain and potentially increase their dividends over time. Number 3. Consider the overall risk profile of your portfolio. While high-yield investments may offer the potential for higher income, they may also carry higher levels of risk. It's important for investors to carefully consider their own risk tolerance and make sure that their portfolio is properly balanced. Number 4. Keep an eye on the economic and market conditions. Changes in economic and market conditions can impact the dividend yields of different investments. It's important for investors to regularly review their portfolio and make sure that it is still aligned with their investment goals. Number 5. Consider the fees associated with your investments. Higher fees can eat into your investment returns, so it's important to carefully consider the costs associated with any potential investments. Number 6. Seek professional advice. If you're unsure about which investments to choose or how to construct a dividend-focused portfolio, consider seeking the guidance of a financial advisor. A professional can help you develop a strategy that is tailored to your specific investment goals and risk tolerance. Number 7. Review your portfolio regularly. It's important for investors to regularly review their portfolio and make sure that it is still aligned with their investment goals. This may include rebalancing the portfolio to maintain the desired mix of assets and making any necessary adjustments in response to changes in the market conditions or the investor's financial situation. Increasing your dividend yields. The dividend yield is a financial ratio that shows how much a company pays out in the dividends each year relative to its share price. It's calculated by dividing the annual dividend per share by the current market price per share. For example, if a company has a dividend yield of 3% and you own 100 shares of the company's stock, you would receive $3 in dividends per share per year, or a total of $300 in dividends. If the stock's current market price is $100 per share, then the dividend yield would be 3%. There are a few strategies that you can use to potentially increase your dividend yields. Number 1. Invest in companies that have a high dividend yield. By investing in companies that have a higher dividend yield, you may be able to increase your overall dividend income. Keep in mind that companies with high dividend yields may also be facing higher risks, such as financial instability or competitive market environment. It's essential to thoroughly research the company and its financial stability before making any investment decisions. Number 2. Diversify your portfolio. Diversifying your portfolio by investing in a variety of assets, including stocks, bonds, and other securities, can help to spread out the risk and potentially increase your overall dividend income. This can be especially important if you are relying on your dividend income for a significant portion of your income. Number 3. Consider investing in dividend-paying mutual funds or exchange-traded funds, ETFs. Mutual funds and ETFs are investment vehicles that allow you to invest in a diverse portfolio of securities, including those that pay dividends. By investing in these types of funds, you may be able to access a larger pool of dividend-paying investments and potentially increase your dividend income. Number 4. Reinvest your dividends. Some investors choose to reinvest their dividends rather than receive them in cash. This can help to compound your returns over time and potentially increase your dividend income. It's important to note that investing always carries some level of risk, and it's important to carefully consider your investment goals and risk tolerance before making any investment decisions. We recommend that you consult with a financial professional or do your own research to determine the best strategy for maximizing your dividend income. That was it for this time. We'll meet again in a later video with more amazing content.